This is CNN Vantage Point. I'm Jay Over, investment strategist with CNN Wealth Management, and today's podcast will provide a market review for the month of January 2024 and our current outlook. Equity market performance in January continued several themes that largely persisted throughout 2023. Growth stocks again outperformed value stocks, with the Russell 1000 Growth Index outperforming the Russell 1000 Value Index by approximately 2.4%. The S&P 500 Index reached an all-time closing high of 4,927 on January 29th. The S&P 500 Index returned 1.7% for the month, as U.S. large company stock returns once again surpassed U.S. small company stock returns, as the Russell 2000 Index declined 3.9%. International markets continue to lag, as both the MSCI EAFE Index and MSCI Emerging Market Index failed to keep pace with the S&P 500 Index. The U.S. economy remains strong, with the advanced reading of fourth quarter GDP showing economic growth of 3.3%. Inflation levels continue to improve, with the most recent core personal consumption expenditures index showing inflation increasing at a 2.9% year-over-year rate. This is the smallest annual inflation increase since March 2021. As expected, the Federal Open Market Committee left the Fed funds rate unchanged at their January meeting. However, the committee pushed back on near-term rate cuts, noting their intention to maintain the current monetary policy rate until greater confidence is reached that inflation is moving back towards the Fed's 2% target. The futures market is currently pricing no rate cut at the Fed's upcoming March meeting. Continued economic momentum put modest upward pressure on longer-term U.S. Treasury yields. The 10-year Treasury yield rose 11 basis points during the month to end January at 4%. Shorter-term Treasury yields, however, were little changed. In January, the U.S. dollar index increased 1.9%, oil prices rose 5.9%, and gold declined 1.1%. Economic growth, continued disinflation, and a Fed that is leaning towards rate cuts rather than hikes bode well for investors, and this optimism has helped propel multiple equity indices to all-time highs. In addition to the S&P 500 Index hitting an all-time high, the Dow Jones Industrial Average and the Russell 1000 Index both reached record highs in late January. As investment managers, we are encouraged by the positive economic trends we are seeing, but our excitement is tempered at the current time by equity valuations that have increased alongside strong equity returns. Our portfolios retain an overall neutral equity allocation. However, we rebalanced client portfolios in January to increase our mid-cap exposure while simultaneously trimming large-cap value and international equities. We believe the favorable economic outlook and lower interest rates will provide a greater tailwind to mid-cap equities. Additionally, mid-cap indices remain below all-time highs. We believe the current market environment is favorable for equities. We are actively reviewing our portfolio positioning and may look to further increase equity exposure if a market pullback occurs. We'd like to remind our listeners that market conditions can change quickly. As circumstances and facts change, CNN's market views and portfolio positioning may change accordingly. If you would like more information about our current positioning and market thoughts, please contact any of our wealth management advisors. And if you like this podcast, we'd be grateful if you would share it with your friends. On behalf of the entire CNN Wealth Management team, we thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.